Good evening, ladies and gentlemen. A very warm welcome to all the participants of today's webinar on the topic of risk management, organized by the Board of Internal Audit and Management Accounting of the Institute of Chartered Accountants of India. It surely promises to be an enriching one for all of us. I would like to take this opportunity to thank our institute, Nandaji, and our board for setting up such an enlightening topic of risk management. So, Nandaji, welcome. So, sir, before starting the meeting, can you please share a few words about this meeting?
Thanks a lot, Mr. Kulkarni.
Yes, sir.
C. Kulkarni. My salutations to Madam Shruti Gupta, who's also a chartered accountant and works with Unilever. C. Aarti Bansal, the secretary, Arun, Hemil, and all who have come here to go home unenlightened. Ladies and gentlemen, we are back with yet another exciting session on internal audit. And again, one of the very sunrise areas, particularly risk management, risk mitigation. I would like to very candidly put on record that because business propositions have become so complex that risk mitigation in itself is an area which needs to be developed and which needs to be consulted to your clients, may they be the clients, stakeholders, or regulators, or the government. Ladies and gentlemen, a chartered accountant need to always put across his findings before the audit committee or the board, as the case may be. And therefore, he is the person who guides the board about the risk mitigation awareness issues. We are all aware very clearly that risk appetite is of the board. But risk mitigation, what are the plan in case a risk comes from nowhere, how that has to be settled, is a duty of the professional who takes care of risk mitigation. I would like to tell you that internal audit started at a small facet whereby processes were looked upon. But over the years, risk-based internal audit has become the call of the time. And very importantly, risk management, risk mitigation have become very important. I remember a gentleman giving a call to me. He said, Mr. Nanda, I want to do a business and I would request you to tell me any area where there is no risk. I smiled and said, my friend, I'm a CEO of 33 years age, and I'm trying to yet determine an area which has no risk. And to put it very rightly, if there is no risk, there is no opportunity. If there is no risk, there is no return. So using the right risk, taking calculated steps with terms to risk mitigation, and then creating value and worth for your organization, whether you are an employee there or whether you are a consultant there, would ultimately set a tone to this great profession, which ushered upon a great era of new professional opportunities for us chartered accountants. You all are very well aware that the Institute of Chartered Accountants of India was set up an Act of Parliament way back on 1st July 1949, when the most important document to the democracy, the Constitution, was not adopted. All of you are aware that the Constitution to this great country was promulgated on 26 January 1950. The pertinent question that arises is, what prompted the Constituent Assembly to set up an Institute of Chartered Accountants of India when its own democratic setup was not in place? The answer is very candid, very simple, very forthcoming. They were looking for a disciplined band of soldiers to steer this country out of confusion. And there we are. The financial soldiers of this great country. So, ladies and gentlemen, when it comes to internal audit, risk management and mitigation is a very important facet. People still think that risk mitigation is a novice area where people are struggling to do add value. But in fact, it is totally established. And I have reminded a couplet in this regard. The couplet says, मुझे क्या कुछ इन लम्हों में पढ़ लोगे दोस्तों, मैंने खुद को लिखने में बरसों लगाए. So this risk mitigation, risk management discipline has been working since long. And today there are such well-settled practices that ultimately, in case of any problem, any fudging, risk mitigation comes to help and ensures that the business works on and the going concern concept of the business remains intact. We have Shruti Gupta, who has a very good, enviable career of risk management. Even Vijay Kulkarni is a very seasoned inter-audit professional. Madam Arti has been in this board as a secretary, and I, as the chairman, am the founder chairman of this board. 2004, when I came to the council, I founded this inter-audit standard board. So all of us have been having a long association with inter-audit, and therefore we bring before you jointly a great program on risk management. I will not speak much. I will not stand between you and Shruti ji. So the dice goes back to Vijay Kulkarni ji. Kulkarni Saab, the dice is all yours. Please take things forward. Thank you. Thank you so much.
Thank you, sir. Thank you, sir. It was a great. You gave us a great understanding of the risk and the risk management. So to understand how this is done and to provide us with more clarity on risk management, let us welcome our esteemed speaker, CA Shruti Gupta. Please join me in extending a warm welcome to CA Shruti ji. Let me give you a quick introduction of CA Shruti Gupta, who started her journey with Sriram College of Commerce and completed her BCom in 2007. Later, in 2009, she completed her Chartered Accountancy exam, and from 2010, she was into business planning and analytics in Bharti Airtel Limited. And from 2012, she got into Make My Trip India as financial planner and analyst. In 2017, she joined Diego India as regional analytics head, and from 2019, she is into various positions in HUL and Unilever as category finance nutrition, South Asia RTR head, and from 2023, she is risk and controls lead of Hindustan Unilever. She mentioned in her the data which she gave, her superpowers, that is the strengths are simplifying complex problems, clear communication, driven and result oriented. I welcome CA Shruti ji to please take over. Ma'am, the stage is all yours. We are all waiting for your deliberations.
Thank you so much, Vijay. Good evening and welcome everyone. At the onset, I would like to thank the esteemed committee and its members for giving me an opportunity to share my experience on the practice of risk management and the leading ERM practice that the world is seeing right now. A special mention to Sir Nandaji and of course to you as well, Vijay, for introducing the session, introducing me with all your kind words. I will take the opportunity to just share my screen and show you what I have prepared for this session. Give me 1 minute. Please do confirm to me when you can see the screen.
Yes, ma'am. Screen is visible.
Okay. So kicking off the session, risk management is a very wide ocean. From our day-to-day decisions, like crossing a busy road, or probably going to the market, or probably taking business decisions which have a financial implication or an operational implication to the organization, risk management is required everywhere. Even when you are crossing the road, it's your brain who's doing the calculation at the back end of whether it is the right moment to cross the road or not. So risk management is embedded in our brain, in our organization, in everything that we do. Even if it is a government deciding their policies or us deciding our next investment, we do risk management. It is relevant for our fellows in consulting, and as rightly put by Anandaji, it is very important for us in practice, in consultancy, and even in service for the organization that we are working for to manage risk, to understand, identify, and manage risk. In our day-to-day lives, what more we do? I mean, in not just risk management, we also mitigate the risk. We also make sure we are insulating ourselves against these risks. So while we are doing all this in our daily lives, what extra do I have to share in this session? So today I reserve around an hour of your time to take you through a structured approach to risk management, the context of it in an organization, and a limited global dialogue around it from expert risk measuring agencies and organizations. Presenting to you the agenda. So we will be covering revisiting fundamentals, brief two slides on what exactly is risk. Then I will take you through the risk management, a structured approach to risk management. What is enterprise risk management? This is a very important and evolving tool that has some global framework supporting it. And it is a tool which is used by every listed organization today in nascent terms, in an evolved term. But yes, this enterprise risk management is something that we are doing in every organization without even knowing. A case example to just highlight how risk management and enterprise risk management practice can help and emerging risk globally. I will finally round up my session with small key messages to take away in the context of emerging risk, in the context of global evolution of risk, in the context of our response towards risk. Moving on, revisiting fundamentals. Why do we need to understand risk? So risk has its origin in many languages. In Italian, the word risco. In French, the word risk. In Spanish, resigo, and in Latin, resicum. These are the words which are giving us today the word that we use very commonly, which is called risk. I'm sure it might have some relevance from our Sanskrit as well, but I'm yet to find that out. There are many definitions around risks. Risks are those uncertainties which impede the achievement of an objective of the organization. This is one of the most commonly used definition of risk, where we highlight that risk is an uncertainty where an organization objectives might not be achieved. Every organization exists for an objective. That objective might be, even an NGO, that objective might be either profit making or delivering the purpose of the organization by improving the livelihood of the people that the organization is working for. So, in case there is a risk to the organizational objectives, it is very important to manage those risks in order to make sure that the objectives of the organization are achieved, and there is an upside to the risk which can be milked in order to handle that risk properly. Another definition of risk is that is given by the Institute of Risk Management is that risk is a combination of the probability of an event and its consequence. This gives us the components of risk, and I would like to spend a minute on this one because this really gives a structure to the risk management and to identify a risk. For example, there is a risk statement which says COVID or pandemic lockdown results in a decline in discretionary consumption, which could lead to an economic slowdown. Now, you would notice I have highlighted a couple of words. These words are nothing but the components of risk. There is a cause of the risk. For example, in this statement, the COVID or pandemic lockdown is a cause to the risk. Then the decline in discretionary consumption is the event that happened because of this risk. While we were there in lockdowns, we did not really go out for dining. We really did not go out for traveling or anything which was discretionary. Thus, there was a decline in discretionary consumption in the economy, the consequence of which was an economic slowdown. We all know how our economies, the global economy, suffered during the pandemic due to reduction in discretionary consumption. What I'm doing with this risk statement is breaking down the risk into components. Every risk has a cause. There is an event due to which a risk happens, and there is a consequence to it. While we understand all these three components of a risk, we will be able to place the right methodology to understand the risk, to identify the risk, to understand the effect of this risk, and to understand how we need to mitigate or contain this risk. Moving on, every risk has a dual nature. There might be a couple of risks which are only hazardous, do not really pose an opportunity, but mostly risks have two sides, either only an uncertainty or an opportunity as well. Organizations which are mature, they normally look at what an upside opportunity an oncoming risk is offering. Let me take an example. There are various sustainability regulations and disclosures that have come up as part of the SEBI LODR requirements. Now, when we look at these disclosures, there is a risk of reporting because a lot of disclosures here are related to our value chain partners. So the maintenance of these records with the value chain partners, the accuracy of the records with the value chain partners might be a little bit of an issue. However, the opportunity, if we are able to contain this risk, is that we are a better disclosed organization. We have a more sustainable way of handling our business, and we become more inviting or more attractive to our investors and other stakeholders. So this is a very typical example of every risk and opportunities associated with it. On a lighter note, I would also like to take example of our daily or our fun way of looking at risk. For example, I want to go for skydiving. Now, the skydiving can pose a risk to my life. Falling off a plane or jumping off a plane might not be the best thing to do, of course. The consequence of this activity might be the fun that I am looking for, right? That is the opportunity. The downside is the loss of life that skydiving can offer. However, I would still take that risk in a very informed manner, make sure my parachute is in place, make sure I'm trained for it, or I'm at least jumping with the trainer, or probably check the ID of the trainer whether he is trained or not. As part of the risk management by the trainer, he would also make sure that I sign a declaration form that if something happens to me, he is not responsible for it. Right. So risk management and risk pose an opportunity as well as a risk, mostly for us in our daily lives, also for us in our organization. Moving on, when we talk about the types of risk, there is an entire word cloud that comes in. There are many definitions which are available. There are many types of risk which are available. A risk can be external, it can be internal, it can be controllable, it can be a non-controllable risk. There might be financial, operational, strategic risk, compliance risks, risk related to reputation, knowledge, technological risk, credit related risk, interest rate risk, foreign risk, market risk, liquidity risk, business continuity risk, data security risk, safety risk. There might be n number of risk which an organization might be facing or we might be facing in our daily lives. And I'm sure that you would be getting at least 10 more types of risk in your mind right now which might not be covered here. And such is the nature of risk. It's dynamic, it's evolving, and it's not containable, the kind of risks that are coming that are evolving in our day-to-day practices. There is a framework which is given by the Institute of Risk Management, which kind of tries to contain all these types of risk in this particular diagram. Taking a moment to explain what exactly this diagram is, there are risks which are externally driven and there might be risks which are internally driven. Now, these risks can also be divided into financial risk, strategic risk, operational risk, or hazard risks. You can see there is a center circle which kind of help us understand that even a financial risk can be internally driven or a strategic risk can be internally driven, and the outer ranges which do not lie in the circle are externally driven. Financial risk, interest rate risks, foreign exchange risk, credit risk might be externally driven. At the same time, liquidity and cash flow might be internally driven, something which we can impact internally within the organization. Strategic risk coming from outside competition, new competitions coming in, new competitions coming in terms of our products or services that we offer, any customer changes that might happen outside our major customers going out of business, probably we might need to find new customers or something like that, might be a strategic risk. There might be industry changes, whatever we are in, there might be more substitutes coming into that product, right? So there might be industry changes, there might be customer demand which might be fluctuating. For example, very typical for an IT industry to go out of business because there was a change in the customer demand. M&A integration, if you see, there is a dual role over here. It is internally driven as well as externally driven. While an M&A assignment is what we can take and we can do all our due diligence, if not integrated properly in your regular business as usual, M&A integration can pose a big risk. It can lead to any oversight penalties. It can even lead to the business cases not getting delivered in case your integration strategy is not functioned properly. Then research and development, intellectual capital are a couple of strategic risks which are internally driven. Operational risks, regulations, culture, board composition. These are the risks which are operational and external. Regulations, there might be proliferation of regulations which we need to adapt to on a day-to-day basis. There might be new regulations coming in. There might be constantly changing regulations, and us to keep a track of it and to adapt to it might take a bit of time. So these are the operational risks. There are cultural risks, there are board composition risks which might come as operational risk. Then internally, our accounting controls, information systems are internal driven operational risk. In case our internal systems are not working properly, in case our information systems are not robust enough, we might face operational issues. Then recruitment and supply chain are two more risks which are operational in nature and which have both internal and external component to it. Of course, we all will understand recruiting someone who's not fit for our team or organization can pose a lot of challenges. So of course, that is one of the most important risks. Then hazard risks. These are the risks where we might have some issues from contracts, natural events, for example, a calamity striking one of the part of the organization or one of the part of the country where we have interest. Then suppliers environment, these are all related risk to external environment. Climate issues are the most important and emerging risks right now, and we will talk about that later. There is an entire section that I have dedicated to that. Then public access risk, employees, properties, product and services, these are internal driven risk. They do have a slight external aspect to them as well, but these are hazard risks that can pose an organization to not achieve its organizational goals. I'm sure after this as well, there might be a lot of risk which might be coming to your mind, which is not a part of this. And hence, this model or any list available in terms of risk types is not comprehensive or exclusive, but we can, of course, add more to it. Moving on, risk management. So, what is risk management? Risk management enables management to deal with risk by reducing their likelihood or downside impact. It aims to protect the value already created by the organization, but also its future opportunities. So, in layman terms, if we talk about risk management, it has two sides: protecting value and making use of the opportunities which the risk might throw at us. When we talk about protecting value, we talk about, for example, there is a regulatory change that came in. In case we do not change, or if our risk management is not proper and we do not adapt to that regulatory change, we might have to pay more penalties, fines, and we have to probably face business continuity issues as well. Thus, risk management is imperative for protecting value. Also, as I have highlighted earlier, in the same example, for example, there are regulatory changes. There might be opportunities which these risks can throw to us. For example, in the same BRSR disclosure requirements, in case we are compliant to that, we might be more attractive to our stakeholders, to our investors, and to people who would like to invest in us. There are a big section of consumer who is currently looking at opportunities to associate themselves with an organization which is more sustainable, which is more compliant. And thus, every risk might have a protecting value aspect to it as well as an opportunity aspect to it. What is a risk management process? And here I start my journey of breaking down the process of risk management into steps to give you a very structured approach to risk management. For example, identification of a risk. For every risk management process, it is extremely important to identify what can go wrong. Any new event which is coming our way, we need to assess whether that event is good or bad for us. That is the stage of analyzing the risk. Then evaluating the risk. In evaluation, there are a couple of techniques which are offered by various frameworks, but talking generally, we need to measure how this risk can impact us. What is the likelihood of this risk really coming in? For example, there might be a risk that we might be visited by one of our regulatory authority, right? But what is the likelihood of something like that happening is something that we evaluate. and mitigate the risk. Of course, after we identify the risk, after we assess the risk properly, we need to mitigate the risk. We need to create our strategies, processes, plans, proper governance model around the risk to mitigate the risk, to contain it, or probably to treat it. Also, risk management is a continuous process. Only identifying it and analyzing it, evaluating it, mitigating it won't solve it. It is dynamic. We need to monitor it. We need to monitor it continuously. And why we need to monitor it continuously? A risk mitigation that we might have put in place, we need to check whether that is working or not, whether it is effective or not. After putting a risk mitigation, there might be new branches of risk coming out. For example, a risk that we have mitigated related to a competition, there might be new competitors which might be coming, and we might have to put in the same mitigation or customize the mitigation for the other competitions as well. So risk management is never a stable process, or a one shot process. It requires to keep an oversight. It requires to us to update the risk. It requires us to monitor the risk continuously in order to make sure that our plans, our strategies are working. If there is a need to revise the strategy, if there is a need to revise the risk, if there is a need to make sure that the risk is completely contained. Breaking down the risk management process into steps. Risk identification. What can go wrong? So, risk identification is an action or process of identifying some potential event or threat or vulnerability or a fact that could cause damage to the entity or prevent it from achieving its objectives. To put it in layman terms, to put it in a very simplified term, and that is what I like doing, frankly. Risk identification is nothing but identifying what exactly is the event which is coming to disrupt our business as usual. A risk identification technique may be either an entity level or a functional level discussion, which is an internal. For example, we can discuss internally with our stakeholders, with our business teams, on any new risk that they see. For example, our sales team might show a risk of a new channel coming up, or our supply chain team might come up with a risk in the supply chain context, in the disruption that might be there, a commodity price going up, global war impacting the availability of any important raw material that we are using in our production, etc. So entity level, function level discussions are something which can give us the right measure to identify a risk which might be coming to us. Doing these discussions regularly help us keep up to date to the risk that might be coming in, and anything which is better informed or early informed is better contained and early managed. So thus it is extremely important for any risk function to keep these functional level discussions and entity level discussion in place. The other one is analyzing internal or external industry factors. There might be changes in industry. This is very common with IT industries, where new technologies keep coming in, where new services keep coming in, and where we need to adopt to the new and upcoming themes in the industry. So, a constant measure of analyzing the factors in the industry, which might be internal or external factors, is a key to identify risk, is a key to understand the risk. Understanding global or economy specific emerging themes. Now, this is where a lot of discipline comes in terms of understanding global or economy specific themes. There might be new socio-political environment or scenarios which might be emerging. There might be a couple of events that are happening globally. There might be a trend that has been started globally which might impact us. So early identification of these trends, being in touch with the global emerging themes, definitely help us understand what might be the risk which might be coming towards us, identify the risk at the right time in order to put a treatment to that risk in an advanced manner. Risk identification approach can be a top down approach or a bottom up approach. And what I mean by a top down approach is, for example, in a big strategy meeting, the leadership team, or the management committee or directors or board of directors identify a certain risk, and they can share that risk top down to the organization and communicate it. A bottom up approach is mostly when we talk to our functions, to our entity, to various business units, and understand what might be the risk that they might be facing. This help us stay near to the grassroots. This help us pick up even the smallest of the risk. Of course, this also give us a wide list of risk that we have to consider. But then the next step that I will come on to will help us understand how we can rationalize this list and come to our top risk. This is the step when we identify a risk that we start preparing a risk register for ourselves. Risk management process. This is the step 2 to manage the risk, which talks about assessing the risk, analyzing and evaluating the risk. So basically, I have combined the step 2 and 3 because practically both the steps go hand in hand. When we analyze the risk, of understanding whether there is a quantifying, whether the risk is quantifiable or is it a qualitative risk, and evaluating the risk when we kind of give it a score of likelihood or impact, a rating, and highlight which risk might be more oncoming to us, which risk might be of more impact to us, and which risk we can understand into our risk appetite and not really be bothered about. So once businesses have identified the risk, they will assess the possible impact of those risks, positive and negative, right? So the business also needs to analyze and evaluate that the risk that is coming towards them, which normally has a downside as well as upside, is there a positive and a negative side to it? How best we can utilize the positive side of that risk, and how best we can ignore or insulate ourselves from the negative side of the risk. This will further involve determining the likelihood, consequence, and impact of each risk and creating the risk rankings. Now, of course, we can understand this is a judgmental sort of a process. While an organization can put a risk rating of severe to a certain risk, another organization or another person in that same organization put a high risk rating to that risk. And it is, of course, judgmental. It is also a function of what information is available to the person. It is also a function of what stage the organization is in for the person to decide what is the rating of that risk. Taking you through a couple of very, very useful and commonly used terms when we are analyzing and evaluating risks. Likelihood. The probability of an event happening is the likelihood of an event. For example, some event might be very likely to happen, and there we might give it a score of 4. These are illustrative risk matrices. Of course, every organization, every individual can use a different risk matrix. Any organization can put a risk as a very likely risk, a very unlikely risk, likely or unlikely. For example, COVID hitting us again this year might be unlikely, right? But a global event like the war that is happening right now might be a likely event that might happen. Then the impact, consequence of the event. Their impact of an event can be either severe or low. In case there is a low impact, we normally do not take it into our risk register. However, if it is a severe or a high impact one, we normally consider it. Risk rating. Risk rating is nothing but a function of your risk impact and likelihood. So for example, we have assessed something as likely to happen in terms of likelihood, giving it a score of 3, and we can say that it has severe consequences. The impact is severe of this particular risk hitting our organization. Thus the risk score will be 12, and then it will come into the category of severe risk. So giving a risk rating help us decide where we need to dedicate the organization resources, where we need to put more focus into the organization, where we need to understand that this risk has a severe consequence, this risk has a high rating, and we need to probably report it outside if it is a listed entity, or probably at least keep the board of directors or risk management committee informed about these risks which might be coming in. So risk assessment enables us to create a risk matrix with risk scores for each risk. And of course, giving a score to each risk is important for us to analyze which risk is important, which risk is under our appetite, and we can live with it. This is an illustrative heat map of assessing a risk. This is a very, very common practice in every organization which is following enterprise risk management, to create a risk matrix plotted on heat map and understand where exactly these risks are posing. You would see I have introduced one more variable over here, which is the speed of onset. For example, taking the example again of COVID, when it came in, the speed of onset was extremely hitting. It was very high. It came in, the velocity was so high that it was an immediate lockdown. It was an immediate uh, BCP situation for any organization. Helping you understand a bit around this heat map, if you see risk number 1, which is a COVID law compliance, is put in as high velocity or high speed of onset, whereas it is put lower on likelihood scale because we've just been hit by that, and certainly hope in all our senses that does not come back again, but the impact will be high. So it is placed in the matrix, in the grid, in a way which can highlight where exactly is the position of this risk in our overall risk matrix. Taking another example of risk number 7, which is around lower opportunity for sponsorship. This definitely is a very key risk, as we see in this particular chart. This has a high speed of onset. This has a high impact, and this has a very high likelihood. Of course, this is illustrative because if I would have created this heat map, this wouldn't have been risk number 7, but would have been risk number 1. Accordingly, we can see at risk number 2, which has a lower speed of onset, which is around a cyber attack. It has high impact, but lower likelihood. This looks like an organization which is mature in their IT systems, and say that the velocity of such a risk happening and the likelihood of such a risk happening might not be very great. But in case something like this happened, the impact will be high. Probably it's a data-driven organization. Moving on, the treatment of risk. And here we come to the most actionable part of our risk management process, mitigating the risk. The creation and implementation of risk mitigation strategy is one of the most effective ways to protect an organization's objectives. We need to really adopt the mitigation strategy every risk wise. The primary objective of risk mitigation is either we need to avoid the risk, we need to reduce the risk, we need to transfer or share the risk, or we need to accept the risk. Taking you through the four objectives of our risk management. Avoiding a risk. When do we normally avoid a risk? A risk which is very hard hitting, action undertaken to eliminate risk, we need to eliminate it. We need to avoid getting into an event of this magnitude, and we need to avoid this risk hitting our organization. This is one of the most important ways. For example, any regulatory update that has come to the organization, we need to avoid getting into the wrong side of that particular risk. In case we do not do that, we will have to face penalties, risks, fines. We need to protect our value. We need to protect our organization. It can even lead to the organization starting a BCP in case we are not able to combine our actions with the mitigations of avoiding such a risk. Then reducing a risk. We need to take an action to reduce the risk likelihood or impact, or both of this particular risk. For example, a new competition coming in. We need to reduce the impact of our share loss with that competition coming in. We need to adapt our mitigation strategies. We need to adapt our processes. We need to adapt our response to that competition in such a way that our market share loss, or probably defending the share in the market, is robust. We need to reduce, if the share loss over there to the competition is massive, we need to reduce our spending on that particular area, or probably find a way where we can invest in our organization in another way and make more out of our investment, rather than in that particular area where the competition is very, very robust and we are not able to kill the competition. Then transfer or share the risk. This is normally when a third party comes into picture. So, for example, in supply chain, we have stock in transit. We kind of reduce the impact of any risk which might come to us with that inventory in transit by ensuring it, by asking our logistic partner to indemnify us with any risk which might be there, which the inventory might be facing. So, of course, insurance might not really cover the risk completely. We still have to bear some part of the risk that we might be hit with. But this particular approach or objective of risk management is to transfer or share the downside of that particular risk. The other one is around accepting the risk. Where the risk implications are lower than our appetite level, we normally accept that risk. For example, a small change to our labeling requirements might be something which is extremely acceptable. We might just need to change our packaging and highlight more on the labeling requirements. But this is something which is extremely acceptable and lower than our appetite levels. So risk treatment is marked by controlled self-assessments. We need to do self-assessment, and as we have already seen, it is a continuous process. We need to do controlled self-assessment of the risk which might be hitting us, strengthening the governance and internal controls, and creating BCPs. These are very crucial to treat a risk, to mitigate the risk.
Shruti ma'am?
Yeah. I'm sorry, I'm not able to hear you. Vijay, I'm not able to hear you, sorry. Are you able to hear me?
Please, yeah, I'm able to hear you.
Should I continue? Could you confirm if I can continue? I will reshare my presentation. Please confirm if you can see the presentation.
Yes, ma'am.
Okay. Moving on to the continuous process of risk monitoring and reviewing the risk. Once an organization has created an action plan to tackle the risk, it should put in place some frameworks that can monitor the risk, its impact, effectiveness, along with new risk emerging from the mitigated risk. For example, risk monitoring may involve reviewing risk register to add new risk. As we discussed, a risk when mitigated can branch out. It can evolve, it can change its form. And thus, it is extremely important for us to keep reviewing these risks. It is extremely important for us to keep monitoring these risks and review the risk register to add the new branches of these risks, any new risk which might be coming in. Monitor risk response plans. We need to monitor how our response plans are effective. If not, is there a need to change the mitigation? Is the mitigation working, or the mitigation needs to evolve, or the mitigation needs to be changed in scale? And identify the trigger conditions. There might be a couple of trigger conditions which we can foresee. And the monitoring and reviewing of risk continuously help us understand these new trigger conditions which might be coming in. It helps us identify new risks which might be coming in and then mitigate them in a timely, in an advanced manner. So not all risks can be eliminated, and we saw that in the previous slide. Some risks are always present and thus need continuous or periodic monitoring. So while the risk environment itself is dynamic and evolving, the risks are also changing, and thus a continuous monitoring is required. Many organizations also put in a lot of sophisticated tools on controls continuous monitoring, the CCM models that we put in. There are also manual methods and tools for monitoring risk. There are, of course, tool-based and very sophisticated tool-based methods for monitoring these risks. So who is responsible for risk management? A risk management function cannot entirely contain a particular risk or look at all the risks which an organization or a person might face. There are many functions. There are 3 line of defenses which are responsible to monitor risk. The first line of defense or the control operators are the ones who are there in the day-to-day operations. They are the ones who would know any risk coming to them the first, if it is not a strategic risk or if it is not a top-down risk. The risk owners need to identify, need to be informed, need to understand and assess the risk associated with their roles and responsibilities with the day-to-day activities. For example, a supply chain person would understand the risk related to third parties when he is dealing with them in his day-to-day activities. Also, embedding the risk management process and operations of processes and controls in our day-to-day lives, in our strategies, an extremely smart thing to do, and that help us understand risk and mitigate it there and then, rather than we calling on committee meetings for every risk which is coming in. A person needs to be empowered in an organization to understand each and every risk from their point of view and need to be empowered to mitigate that risk at his own level. In case the risk is above his appetite, the risk person needs to be informed. The central risk function or probably the second line of defense needs to be involved. Thus, accountability for design and execution of internal controls, both operational and financial, are a part of the first line of defense. The second line of defense includes review, guidance, and challenges from management of the first line of defense and oversight of a central risk function in management activities. So not every organization would have a central risk function. Very evolved organization have a very evolved risk function where there is a chief risk officer reporting under a chief executive officer directly and has an entire control function under him. There might be a single person who might be doing or running a risk function in our organization, or it might be a decentralized sort of an approach if it is not a very risk mature organization. So a central risk function, if absent, the second line of defense is the second line of management to the first line of defense. So, for example, in the example we took of the supply chain person, in case the supply chain person is not able to analyze the risk which might be coming to him from the third party, he can go to the management, he can go to his line manager or boss or probably the head of his department to share that risk and help and ask for help for the mitigation of that risk. So that forms the second line of defense in that case. The third line of defense is the independent and objective reassurance that our internal auditors give. That is the third line of defense because they are independent, they can understand the risk in a context which is not available to the first line of defense and the second line of defense because they are into the day-to-day activities. So assurance over the practices of risk management by the first line of defense and the second line of defense is what the third line of defense offer. And the direct reporting to the board help them stay independent. They can independently assess whether the risk management practice of the organization is fine. Is it dependable? Is it something that can be leveraged, or is it something that needs to be tested periodically and refined periodically for a better risk management culture in the organization? Moving to the concept of enterprise risk management. Why do enterprises need to have a structured approach to risk management? The new normal is changing. We have a lot of issues. We have a lot of external environment changes that are happening. The environment in the organization is also changing. There are a lot of dynamics that are moving, and thus an organization needs to have an enterprise risk management tool that can insulate it from the risk which might be coming in. In modern corporate organizations, there are a host of risks that might be coming in. It might affect them operationally. It might affect them regulatory in the strategy. It might even affect them financially. So a simple awareness of risk and a simple band-aid approach to stay ahead of the risk might not be sufficient. There is a more structured risk management approach which is required, and we must find ways to mitigate, manage, and accept or transfer these risks. This is something that we have just seen behind in our risk management process. That risk management process is also a structured way of handling, and the enterprise risk management framework takes a bit from that risk management process and gives a structured methodology to the organization to handle risk which might be coming to their organization goals. In older risk management models, the potential risks were handled by the departments. It was a silo approach where every department was required to handle the risk associated to their own department, and we can only understand the kind of synergy losses that might have happened. For example, the risk of plastics, which is there in the entire industry right now, reducing the usage of plastic. If every department in their own way started reducing plastic and really do not take a centralized approach, there might be a lot of synergies which might be missing, which a central risk function can drive and which they cannot internally analyze. Thus, the older risk management model, while it was working, was inefficient. An enterprise risk management framework will encourage communication through your entire company, aligning risk management to business strategy, centrally creating an integrated approach to risk management. So the purpose of enterprise risk management, it is outlined by 2, 3 very commonly used words whenever we talk about enterprise risk management. One is it is a continuous process. Second is it is an integrated approach to risk management. It does not exist in silo. And third, it is not mandatory for now. However, in India, Companies Act 2013 and SEBI LODR regulations have laid down certain requirements for large and listed entities, making it a matter of compliance as well. So, while it is not mandatory, it is definitely encouraged and used by a lot of organizations today. And even if they are not listed, they are reaping benefits out of this practice in whatever way they are handling it. Compliance requirements. I am just listing down all the compliance requirements here just for information. However, I will also go through these, how the Companies Act 2013 and SEBI LODR requirements have highlighted the compliance requirements related to the enterprise risk management. Section 133(3) of the Companies Act 2013 for the board, they have laid down a certain criteria for risk management policy to be created by the board. There shall be attached to financial statements laid before a company in general meeting a report by its board of directors, which shall include a statement indicating development and implementation of risk management policy. Thus, they highlight the need of a risk management policy, which then relates back to the enterprise risk management framework. For company, including identification therein of elements of risk. Thus, this again require a structured framework in the organization for identification of the elements of risk, which in the opinion of the board may threaten the existence of the company. Thus, Section 133(4) highlights the need of a risk management policy and identification of the risk which might impede the organizational objectives. Schedule 4, Section 149(8) relates to independent directors. The independent director shall help in bringing an independent judgment to bear on the board's deliberation, especially on issues of strategy, performance, risk management, resources, key appointments, and standards of conduct. Satisfy themselves on the integrity of financial information and that financial controls and the systems of risk management are robust and defensible. Thus, for independent directors also, there is a need to independently judge the risk management practices in the systems of risk management, whether they are robust and defensible in an organization. Section 177(4) for the audit committee. Every audit committee shall act in accordance with the terms of reference specified in writing by the board, which shall inter alia include evaluation of internal financial controls and risk management systems. Here, there is a need for risk management system in the audit committee itself, which is called out for the audit committee itself. Key compliance requirements by the SEBI LODR regulations for 2015. Regulation 17(9) Board of Directors. It provides that the listed entity shall lay down procedures to inform member of board about risk assessment and minimization procedures. The board shall be responsible for framing, implementing, and monitoring the risk management plan for the listed entity. It clearly calls out the importance and the need to frame, implement, and monitor the risk management plan for a listed entity. Risk Management Committee under Regulation 21. This clearly says that we need to create a risk management committee. Every listed company should have a risk management committee. And here there is the composition of the risk management committee, which is given. The board of directors shall constitute a risk management committee. The majority of members of risk management committee shall consist of board members. The chairperson of risk management committee shall be a member of the board of directors, and senior executives of the listed entity may be members of the committee. The board shall define role and responsibility of the risk management committee and may delegate monitoring and reviewing of the risk management plan to the committee and such other functions as it may deem fit. The provisions of this regulation shall be applicable to top 500 listed entities. So, of course, this relates to the big listed entities in the country, determined on the basis of market capitalization as at the end of immediate previous financial year. The board disclosures as per clause 49 of the listing agreement around risk management. The company shall lay down procedures to inform board members about the risk assessment and minimization procedures. These procedures shall be periodically reviewed to ensure that executive management controls risk through means of a properly defined framework. Why I have gone through each and every clause on this slide is because each and every clause here is extremely important and gives us a new concept around enterprise risk management. We read about a risk management policy. We read about identification of risk. We read about systems of risk management. We read about framing, implementing, and monitoring the risk. We read about its importance in a listed company. We read about risk management committees. And we also understood about the risk assessment and minimization procedures which might be required as per the clause 49 of listing agreement. All these things are very important for us to know in terms of an evolved organization, in terms of a bigger enterprise, and in terms of a consulting enterprise where we need to put these frameworks or analyze these frameworks into the bigger organization. Moving on, what is ERM? An enterprise risk management is a leading best practice approach to effectively manage and optimize business events that have the potential to impact business objectives, enabling a company to determine how much uncertainty and risk are acceptable to an organization. So this definition itself tells us that it's one of the leading best practice. It is a structured approach to risk management, and it is something which can be of great importance and great help to an organization to follow a step-by-step methodology of containing a risk and achieving its organizational objectives. Integrated and continuous approach to risk management. ERM is an integrated and continuous process for managing enterprise-wide risks, including strategic, financial, operational, compliance, and reputational risk. Again, I would like to highlight it says including and not limiting to, because this kind of approach can be applied to any kind of risk that the organization is facing. This is a step-by-step approach. This is a structure which gives us an understanding of how a risk needs to be identified, analyzed, responded to, and monitored in a going concern way. The ERM process is adapted from the overall risk management process that we just saw. The difference is the step 1, where the objectives and risk appetite of the organization needs to be clearly set. What is also important is that enterprise risk management process will also highlight the need for documentation and the need for continuous monitoring, because it is something which the internal audit function also leverages. It is something which is required from a compliance point of view as well, as we just saw in the previous slide. And it is something which will help us, documenting it properly will help us monitor it and understand the evolving nature of risk, evolving nature of our mitigations, and the evolving nature of the entire framework that we have currently in our organization. So the first step in the ERM process is around objectives and risk appetite. Clear set of organization objectives must exist. There must be a clear communication to the organization of what these objectives are. For example, if an organization is purpose driven, for example, if profit making is the clear objective of an organization, it needs to be communicated effectively towards the organization so that each and every member of the organization understand what is the objective of the organization, what that person can do to achieve the objective of that organization, and how an event can pose a risk to the attainment of the objective organization objective. Risk appetite, and we will come to the meaning of these terms probably if it is not already clear. A risk appetite must be defined. Risk appetite is nothing but the amount of risk that the organization can take, the amount of risk that the organization is willing to incur for its organizational objectives. Now we can clearly relate this risk appetite as a term that we can use for our gaming requirements as well, right? While we are doing a couple of games, be it a card game, be it a video game, we do have a risk appetite over there as well. Similarly, every organization also has a risk appetite. Identification and documentation. It is very important for an organization to identify events that pose risk to its organizational objectives. Now, these risks can be external, internal, controllable, non-controllable, and we can really use each and every type of risk that came up into that word cloud. But the organization needs to maintain that kind of oversight, that kind of vision to identify the events that can pose a risk to the organization objectives. Of course, needless to say, the objectives of the organization needs to be extremely clear in order for the organization to identify the events which can pose a risk to the objectives. Risk identified must be documented in the risk register. So whatever risk that we have identified needs to be listed down somewhere in order to see how they are evolving in future, how we can put a mitigation to it, and how we can contain or make a positive use of these risks in our day-to-day activities. Assessment of risk. Organization need to create a risk assessment criteria. This is something that we can relate back to the likelihood and impact and the risk rating and scoring scale that we have seen in the previous slides. Creating a heat map or creating a risk matrix of the organizational risks is something which comes into assessment. We score or rank risk basis approved assessment guidance. Of course, risk assessment guidance also needs to be approved. It can be approved by the risk management committee or the board of director, depends on the powers that the board of director has conferred onto the risk management committee. A risk scoring and a common methodology of scoring the risk is extremely important. For example, a function uses a different approach to risk identification and a different approach to risk scoring, and the other function uses a different approach. When as a central function we create risk rating, we create top risk of our organization, we cannot really marry these risks together. We do not know which risk might be higher, which risk might be lower in our top risk rating, and thus it is important to follow a constant risk assessment guidance throughout the organization so that we can really assess these risks and place these risks in a proper manner in the top-down approach. The response to the risk. Organization need to consider all associate costs and benefits in developing an appropriate response strategy. Of course, we've understood the various ways of treating a risk. We can either avoid it, we can even adapt to it, we can eliminate the risk completely, or we can reduce the impact of the risk, we can share the risk or transfer the risk. All these responses come here. The organization needs to be sophisticated enough, needs to be agile enough to create governance framework, to create controls, to create a response, a strategy, a process to risk that the organization might be facing. And of course, monitor these risks. Organizations need proper systems in place to monitor and respond to the changes. These changes might be changes in the risk. These changes might be the changes into the mitigations that we have put in place if there is a requirement to evolve our mitigation practices. Moving on, how do we implement ERM? We understood it is an extremely important tool. We understood the various benefits that the enterprise risk management tool can offer an organization. It is a continuous activity. It is an embedded activity. There are many terms related to enterprise risk management, but how do we implement enterprise risk management? There is no defined step. However, it starts with constituting a risk management committee by the board of directors. This I am talking about for a listed entity, first of all, because that is what the compliance requirements are. Of course, an entity which is not listed can also form a risk management committee as a best practice, but it is extremely imperative for a listed entity to do this. This committee is responsible for monitoring and reviewing of the risk management plan if such powers are delegated by the board to the RMC. So while the risk management committee is constituted by the board of directors also deliberate onto what powers they want to give the risk management committee. The board of directors can choose to review the risk management plan themselves rather than giving it to the risk management committee. However, it is always recommended that this committee is responsible for monitoring and reviewing of the risk management plan in order to empower this committee to really put an impact into the entire risk management process. Determining the risk appetite, risk tolerance, and approach to risk management. Now, there are a couple of terms which are introduced here. Risk appetite is the amount of risk which the company is willing to accept. Risk tolerance is the amount of risk that the organization can work with. And approach to risk management. An organization normally discloses its approach to risk management, which might be an organization can be risk friendly, it can be risk averse, or it can be risk neutral. In case it is a risk averse organization, the organization would normally put a avoid risk strategy towards risk mitigation and not really look at the various upside of a risk. In case it's a risk neutral organization, it would always have a balanced approach. Establishing an appropriate internal environment, including a risk management policy and framework. There is a need for an organization to create a risk management policy and framework. This provides a guiding light for the risk management committee and the central risk function to understand and implement the risk management practices across the enterprise, across the organization. Operate the risk management process. That is, identifying potential threats to the achievements of its objectives and assessing the risk, that is the impact and likelihood of the threat occurring. This is nothing but the process that we have just seen twice actually now with the risk management process and with the adapted enterprise risk management process. Identifying potential threat and assessing it in terms of impact and likelihood is the way to operate the risk management process. Undertaking control and other responsive activities. This is nothing but treating or mitigating the risk that is facing the organization. Communicating and documenting information on risk in a consistent manner at all levels of the organization. Of course, communicating, documenting is something which we have already discussed. Extremely important to communicate it throughout the levels of the organization so that each and every person is empowered to take the decision related to their own roles and responsibilities. Remember the first line of defense that we discussed. Every person is responsible for the risk associated with their role. Otherwise, a single risk management function will not be able to operate in a very competent manner in an organization. And then centrally monitoring and coordinating the risk management process and the outcomes. The central monitoring function, which is the second line of defense, is responsible to create an oversight on the various risk management processes and the activities associated to the risk management process in the organization and monitor the outcome of it. Of course, last but not the least, providing assurance on the effectiveness with which risks are managed. Providing assurance is the third line of defense that we discussed. The internal auditor can provide assurance on the effectiveness of the risk management function and the effectiveness in which the risks are managed throughout the organization with the first line of defense as well. So a risk mature organization would also conduct regular risk culture assessments. Risk culture assessment in the organization is required to understand whether the organization really understand what is the risk appetite of the organization, how they can assess the risk, whether they even understand the risk associated to their roles. So a risk culture assessment by way of surveys, by way of questionnaires, by way of interviews is something which a risk mature organization undertake regularly. Conduct trainings for risk identification and assessment. The function also conduct trainings, and this of course emanates out of the risk culture assessment. If there is a particular department or if there is a particular risk or if there is an outlier where the risk management function understand the need of training, to identify and assess the risk if a particular set of people do not really understand how to identify their risk, or probably new joiners in the organization. These trainings are extremely important for every new joiner, and refreshers are important periodically to make sure that the organization wide risk culture is rich and the organization wide risk management practices are robust. And of course, follow an embedded approach to risk management. This is nothing but what we've already discussed of our first line of defense taking the charge of understanding the risk and the benefits and returns associated with their roles and managing them effectively. So we need to follow an embedded approach to risk management, which a risk mature organization normally does. What are the roles and responsibilities of various committees, various stakeholders in the entire process of risk management? This is a bit of a verbose slide, but of course, I wanted to highlight that roles and responsibilities of risk management is not one person, it is an entire organization. We see the role of business units, which is nothing but again the first line of defense. We see the role of the board and the role of risk management function, which is the second line of defense, and the role of internal audit, which is the third line of defense. So the role of board, the board has responsibility for determining the strategic direction of the organization and for creating the environment and structures for risk management. The board is responsible for setting up the risk tolerance limits and risk appetite for the organization. How much risk can we normally live with? For example, there is a certain a financial decision that the organization needs to make, and there is a certain risk associated with it. How much risk can the function tolerate in that particular risk, in that particular financial decision, is something which is related over here. And of course, this is not the normal day-to-day financial decision that I'm talking about. If this is board level, this is of course the bigger ones which will impact the entire organization. The nature and extent of downside risk acceptable and how they should be managed. This is also something that the board normally determines. The cost and benefits of risk and control activity undertaken. Of course, an important thing to consider while we are mitigating risk is the cost and benefit of the risk or the control activity that we are putting in place. For example, there might be a certain tool that an organization might be using, and that tool is getting outdated, and probably they need to get in a new tool or a new software in their organization. In the cost or benefit of getting that new tool in the organization needs to be assessed. What benefit that tool will give to the organization, and if the cost which is required to be put in to get that new tool is way higher than the benefit of that tool coming in, then of course we can decide not to go for that mitigation, live with that kind of risk, or find a different way to mitigate that risk. The risk implication of board decisions. Of course, the board needs to also clearly define the implication of the decision, of its own decisions. The role of risk management function. A risk management function may range from a single risk champion, a part-time risk manager, or to a full-scale risk management department with CRO reporting under CEO. This is something that I touched upon in a previous slide. A evolved risk organization would normally put in a dedicated risk function and not a part-time risk manager to understand the entire risk environment and to constantly monitor the risk environment of the organization. In a very sophisticated risk mature organization, there is an entire CRO function, which is the chief risk officer, who independently reports under the CEO, gives his input, builds across the organization. Normally the financial institutions have a full-scale risk management department with a separate CRO reporting under CEOs. Their primary responsibilities include setting policy and strategy for risk management, designing and reviewing processes for risk management, preparing reports on risk of the board, RMC, and the stakeholder. Of course, the risk management function needs to report back to the board. It needs to report back to the risk management committee. Coordinating the various functional activities which advise on risk management issues, and building a risk-aware culture within the organization. while the risk management function will maintain an oversight on the entire risk framework of the organization, entire risk health of the organization, they can do so by doing a proper risk culture assessment and being aware that the functions which are required to perform their risk management are empowered for it. How aware the culture is in the organization to understand their risk, to mitigate their risk. So building a
Shruti
risk
ma'am,
aware culture in the organization. Yeah, Vijay. Yes, Vijay. Are you
Shruti
able
ma'am,
to hear me? Yeah.
yeah, ma'am. Earlier the slides were overlapping, and we were unable to view it clearly. That's why I interrupted you. Apologies for
Okay.
that.
No problem. Can you see my slide? We are on roles and
Yes,
responsibilities.
yes, now roles and responsibilities. Yes,
Okay. So while
you can
we
start,
have,
ma'am.
yeah, I hope you heard about role of the risk management function, or do I need to repeat it?
If possible, can you please repeat it once?
Sure. So the role of risk management function, as I repeat, is setting policy and strategy for risk management, designing and reviewing the processes for risk management, preparing reports on risk for the board, RMC, and the stakeholders, coordinating the various functional activities which advise on risk management issues, and building a risk aware culture within the organization. Next, we come on to the role of business units. The business units have primary responsibilities for managing risk on day-to-day basis. This is nothing but our first line of defense. It is responsible for promoting risk awareness within their operations. They should introduce risk management objectives into their businesses. A lot of organization we see when they have their regular huddles, when they have their regular cascade meetings, etc., they normally discuss on the operational issues and they normally discuss on the regular issues. Here they bring in a element of risk management when they have these regular huddles around the issues that the team might be facing and the processes that can be put in or that can be improved. The risk management should be a regular management meeting item for BUs. So every business unit normally needs to maintain a business risk register and they need to update it regularly as well. If there are periodic meetings which are happening within the BU with the single agenda of risk management, it becomes extremely easy for them to maintain an updated risk register. Very important for the central risk management function to leverage this updated risk register, and very useful for the internal audit function to understand that they are already operating in an environment which is already evolved in terms of risk management. Business unit management should ensure that risk management is incorporated at the conceptual stage of projects as well as throughout a project. Extremely important, of course. This is something which we can find in Six Sigma and other project related courses that happen throughout the industry. Any project at the conceptual stage itself need to be incorporated for any risk that might be coming in. Just imagine a project, a big project we have started off, and we have not seen foreseen a risk in that particular project. There is a huge investment that have gone in, probably setting up a plant uh, in a backward area, and we have huge amount of investment that has gone in. However, we have not really understood the risk associated with setting up that project. Probably it is a tribal area where we might kind of face issues from the local public, or it might be an area which is under dispute. Yeah, so there might be a risk element associated with every project, and at the conceptual stage itself it is extremely important for a proper due diligence in terms of risk associated with that project before really initiating or investing into that project. What is the role of internal audit? Of course, internal audit act as the third line of defense. They provide assurance onto the risk management process of the organization. But the role of internal audit is likely to differ from one organization to another organization. An internal audit's role in risk management may include some or all of the following. They might provide assurance on risk management. This is basically, normally they do an internal audit on the risk management function itself, understand what all documentation they have maintained, understand how what practices they have followed, whether they have taken in all the all the inputs from the risk owners, and really worked on the mitigations, whether the mitigations are updated or not. So providing assurance on the management of risk, focusing the internal audit work on the significant risk. So while the central risk function creates a risk register, consolidated risk register for the entire organization, the internal audit team can leverage that risk register. They can really highlight what are the top risks of the organization and treat them as priority, because of course resources are limited for every function. And this consolidated risk register act as a ready reference for the internal audit function to check what are the biggest risk facing an organization, and understand whether their readiness or their preparedness is sufficient enough or not for those particular risks. So they can really leverage the risk register, the entire risk management exercise, and pick up the significant risk and understand the sufficiency of the procedures around these risks with various business units, with management, with the higher authorities. Facilitating risk identification or assessment, and educating line staff in risk management internal control, providing active support and involvement in the risk management process. Of course, it's an extremely important point because we do not live in silos. Risk management function and internal audit function needs to overlap. Whatever are the findings in the internal audit function needs to be fed back into the risk management function for the risk management function to be better informed what are the areas where risk identification is not happening properly or risk mitigation is not happening properly. And similarly, of course, the risk management function gives their insights to the internal audit team for audit hotspots. Coordinating risks reporting to the board, audit committee, etc. The internal audit is an independent function. They report directly to the audit committee, to the board, and thus they can leverage this power and give a risk reporting to the board and audit committee around the health of risk management function of the organization. Needless to say, the risk management policy should set out responsibilities for risk management throughout the organization. I will move on to the next slide and wait for a second to make sure that the slide has moved. Okay, so these are a couple of global frameworks for ERM. These are extremely popular one, the most adapted one. Both these framework help and encourage risk taking and embed risk management in decision making. So the COSO framework, which around ERM, which came in 2017, was designed to provide an applied risk management approach to organizational internal controls. It provides an integrated framework for boards and management in entities. This framework is normally divided into 5 components and 20 principles. All these 20 principles can, in one way or the other, be grouped to these 5 components. Governance culture, that's one of the components that we have understood in the previous slides, are extremely important in risk management. We need to maintain proper governance. We need to create a risk-aware culture. Strategy and objective setting. Without an objective, the person would not know what event can disrupt that attainment of objective. A strategy needs to be in place to obtain that objective of the organization. Performance, review and revision, information, communication, and reporting. All these aspects we've touched somewhere or the other in the previous slides. Of course, this is a very comprehensive framework, and I would encourage our listeners to go on the internet, very easily available, and search for it, how these 20 principles are grouped to these 5 components. A more widely used framework is ISO 31000, which was revised in 2018. This is a personal favorite for a lot of risk managers. Why? Because this is particularly created for risk management function. This framework makes it necessary for an institution to integrate ERM into their systems for accountability and sustainability. Of course, an embedded approach is what they are talking about. In 2018, ISO re-released the ISO 31000 standard with the new version giving streamlined definitions that focus on 8 principles to ERM. Now, what are these 8 principles? The ERM practice needs to be integrated. It needs to be structured and comprehensive. It needs to be customized. Of course, one t-shirt does not fit all. One mitigation cannot fit all. One assessment cannot fit all. And thus, this approach needs to be extremely customized. It needs to be customized for different organizations as well. Inclusive. It needs to be inclusive. Each and every person is responsible for their risk management. Dynamic, because the nature of the organization, because the nature of our external environment is extremely dynamic, our approach needs to be dynamic and adaptable as well. Best available information, human and cultural factors, and continual improvement. As we can see, the first 5 principles provide guidance on how a risk management initiative should be designed. The last 3, principles 6, 7, and 8, relate to the operation of risk management initiative, that we need to consider the best available information. We need to consider a human or a judgmental factor, the cultural factors, how culturally strong or how empowered our organizational culture is in terms of risk management, and continual improvement. Of course, it's a continuous process, and that is something that is always less emphasized. The more we talk about it, the more emphasis we need to put into it, as it is a continual approach. What are other ERM concepts? Risk maturity of an organization. Of course, I have touched for a second to make sure that the slide has moved. Okay. So, talking about risk maturity of an organization. The following aspects in the organization indicate its risk maturity. An organization can be risk naive in terms of being very new to risk assessment, risk aware, that they know that there are risks which are there in the environment externally and internally, risk defined, that they have defined the risk as well, not just aware, but they've defined the risk as well. Risk managed, this is more evolved, that they are managing risk, and risk enabled. Risk enabled is an extremely positive term. While the organization is able to manage the risk, it is also able to milk the benefits associated with the risk. Thus, a risk maturity of an organization is a direct factor of its risk enablement. Internal auditors should refer the same for concluding on the scope and methodology of the audit. In a risk mature organization, the business objectives are defined and communicated. Risk appetite is defined and communicated. Control environment is strong, including the tone from the top, and adequate processes exist for the assessment, management, and communication of risk. Of course, a highly evolved organization also use risk management tools. There are various enterprise risk management tools which are available, and these are very sophisticated tools which high level of risk mature organization use. Enterprise risk management and internal audit. We have discussed on this in the previous slides. I will very lightly touch upon this, that the internal audit is key part of the life cycle of risk management. An organization with well-established risk management processes decrease audit risk. The corporate risk function enables the policies and procedures, and the assurance phase is accomplished by internal audit. The internal auditor would assess the ERM process for design adequacy and compliance to decide whether to rely on the risk register. If it is found reliable, auditor focus on auditing the risk responsible to significant risks. By relying on significant risk as determined by the management, internal auditing becomes more efficient. Then stakeholder value creation. ERM is a definite tool for stakeholder management, for stakeholder value creation internally as well as externally. Imagine an organization where everyone's problem is one person's problem and one person's problem is everyone's problem. An enterprise risk management approach really helps with that. For example, when a centralized risk function takes the input from each and every business unit of their risks, they also make sure that if there are synergies available, they are available to all the stakeholders within the organization. Thus, the process creates value internally. The ERM process look at the big picture and identify not only short-term risk factors, but also long-term factors impacting the entire value chain of business activities and connected communities, creating value for all stakeholders in the process. For example, there might be a particular risk which one of the business unit has highlighted, but we know that this risk is a bigger risk and other business unit also would be impacted, that risk can be shared with that particular with the other business units. The mitigation that might be there for one particular business unit might be applicable for the other one as well. And thus we can highlight not just short term risk factors but also long term factors impacting the entire value chain. The leveraging of mitigations, leveraging of highlighted risk, identified risk of one unit to the other is also possible. Stakeholder value creation, of course, for external stakeholders as well, it creates a lot of value. Imagine an investor which is well informed, imagine a regulatory authority or a body which is well informed of an organizational risk. They can really take an informed decision. The more one knows about the stakeholders and their levels of importance, the more effective and purposeful the risk management strategy will be, improving the allocation of resources to the risks that really matter. Of course, as we say, resources are restricted, resources are limited. So when we know the top risk of an organization, we can really allocate resources properly in a very informed manner to make sure that we are addressing the key risks of the organization. And it provides enhanced working environment and problem solving to all stakeholders, internal or external. Okay, what are the techniques of internal identifications of risk and internal assessment of risk? While we talk about the first line of defense and second line of defense and third line of defense, how can we really get the internal dialogue moving? There are various ways. We can do surveys and questionnaires. We can do scenario analysis. We can also hold risk assessment workshops. We can have incident investigation. This is something which is extremely crucial. For example, there has been an incident in one part of the organization. We can really use the uh, we can really use the learnings of that particular incident, the learning of the of handling that particular incident, and the result of that particular incident to other parts of the organization. Industry benchmarking, this is something which is very commonly used. Normally in an organization, if there are certain risks which are highlighted, they are normally compared to the peer as well, and understood in terms of completeness, in terms of designing whether there are some risk which the management and vice versa. Auditing and inspection, business studies, this is a more evolved form where we look at each business process and describe both the internal process and internal factors which can influence those processes. The top-down cascade, central identification, extremely important. For example, there is a new boards of CI and FICCI, our higher management, our higher leadership teams are aware of it. They can definitely give them as the top-down cascade. They can centrally identify certain risk, even a global risk. For example, there is something which we can see is coming into the global environment. We can see various risk management institutions. A few of them are extremely reliable one. We can identify an emerging theme, a new risk which might be coming in, and we can give that top-down cascade to our business units to incorporate and mitigate their own areas against these risks. And brainstorming and discussions. These are the various techniques which are used to identify internal risk in an organization. In the interest of time, I will take you through this case example in a summarized way. Waiting for a second to make sure that the slide has moved. So Unilever is okay. I'll wait for a second. Do tell me when you can see it properly. Yeah. Are you on the case example slide now? I will wait for a second for it to move then. Are we on the case example, or I can reshare the screen once? Sure. I have reshared. Please confirm when you can see. So we are on the case example slide. Unilever Global has risk management at core of business strategy. This is something that you can find very widely on the internet in the annual report of Unilever, and also in our study material of final of our final examination on risk management, which is 6A. I think it's exam 6A. So risk management is integral to Unilever's strategy and to the achievement of Unilever's long-term goals. What we mean by this is that Unilever has embedded risk management as a part of its strategy. Everything that Unilever does make sure that they are identifying the risk associated with it, and they are exploiting and identifying the opportunities associated with it, and they are determining their long-term business goals in light of the risk management of these risks that might be coming in, or these opportunities which might be generating for us in future. Unilever takes an embedded approach to risk management, which puts risk and opportunity assessment at the core of the leadership team agenda. Unilever defines risk as actions or events that have the potential to impact our ability to achieve our objectives. Unilever identifies and mitigates downside risks such as loss of money, reputation, or talent, as well as upside risks such as failure to deliver strategy if it does not strengthen brand equities or growth in growing channels. Unilever risk management approach is embedded in the normal course of business. So all these highlighted blue words is something which you can see in a highly evolved organization. All these concepts of enterprise risk management are there as a case example in Unilever. They follow an embedded approach. They have it as a leadership team agenda. They identify, mitigate downside risk, also identify, exploit the opportunities. They have clearly defined long-term goals and communicated. They also do proper trainings in the organization, not just for new joiners, but for the existing employees to refresh their knowledge around risk management. The risk management is a part of the code of business conduct for an organization, for Unilever, which says something, which says that it is part of business integrity of an organization to manage risk and put it at the core of business strategy. I would have taken you through the various risk reported by Unilever, but in the interest of time, I will take you to a more interesting concept, which is around emerging risk, global context. While the slide change, I will tell you what I have done for this particular section. This is the last section that we are touching upon. Here, what I've tried to do, I have tried to go through a couple of reports from very, very highly prestigious risk assessing institutions, and see what is their outlook for risk management in future. What are the emerging risks as per them? What are the risks which we might be facing in 10 years? So if the slide has changed, are we on Global Risk Outlook World Economic Forum?
Not yet, ma'am. Not yet.
Not yet?
No.
You're waiting for the slide to change? Tell me
Yes,
when we reach
now
there.
it is perfect. Now it is perfect. You can start.
Okay. So there are a couple of organizations that normally the risk managers depend on while doing their external internal risk assessment to maintain an oversight and to make sure that the completeness of risk register is there, that the top risk include all the risks which are there in the organization or outside the organization. We normally refer to the World Economic Forum. They release a report of emerging risk in the global outlook every year. And this one is an extract from the 2023 report that they have released. They are yet to release the 2024 report. There are other agencies like HSBC, Gartner, Economist, which we normally look into, which we read, and which we benchmark our own risk management and top risks with. So, as per World Economic Forum, the cost of living will dominate the global risk in the next 2 years, while climate action failures dominates the next decade. Explaining you how to really read this chart, the first box that you can see is around the 2-year outlook of global risks right now. The right side of the slide shows the 10-year outlook. So this is really showing why World Economic Forum is saying climate risk is an extremely important risk which we will face in the next 10-year outlook. While the next 2 years say that the cost of living crisis, natural disasters, geoeconomic confrontation, etc., are the top risks, in the next 10 years, 4 out of top 5 risks will be around climate change. Be it failure to mitigate climate change, failure of climate change adaptation, natural disasters and extreme weather events. We have already started seeing changes in weather, its impact on consumption patterns, its impact on availability of resources as well, biodiversity loss and ecosystem collapse. Natural resource crisis is also something which is seen. Large scale involuntary migration. Of course, when the resources will be scarce, of course, when the resources will be concentrated on in a couple of places, there'll be a large scale involuntary migration that will happen. This might also be a function of the increasing geopolitical hostile environment that we are seeing right now. Geoeconomic confrontation is something which they had released as top 3 risk in the beginning of 2023 itself. Erosion of social cohesion and societal polarization. This is something that we have started seeing where where there is not a lot of social cohesion within the organizations anymore. Large scale environment damage incidents, failure of climate change adaptation, widespread cybercrime and cyber insecurity. These data breaches, cybercrime, privacy issues is something which is there to stay. Whatever we might do to contain it, its ever evolving nature and its sophistication of the attacks that we might be facing will be evolving, and we might have to make sure that we keep our guns high if we really need to fight this particular cybercrime. While this is a classical example of realizing that how technology is doing good to us and taking care of making sure we have all the opportunities realized from the upcoming technologies, there are of course cyber crime and cyber insecurity which are growing with it. So this is a classical example of saying how a risk has a downside as an upside both. Large scale environmental damage incidents, large scale involuntary migration, natural resource crisis, these are all examples. It's basically the same risk, but the risk rating changing in the next 10-year outlook. And we definitely need to, as an organization, as an entire industry, as an entire ecosystem, look at our climate change in a more important, in a more uh, judgmental way. We really need to see what each and every one of us can do for climate change. I have moved on to the slide. Tell me when you can see the Gartner and Economist slide.
Yes, ma'am. Slide is visible.
So this is a more recent one. If I talk about Economist intelligence, so there are 10 critical geopolitical risk scenarios that our global economy is facing. The Economist has released a list of around 10 scenarios. This is not something which will really happen, but they have released probability and impact uh, metrics of these scenarios in light of the recent wars that we have seen, be it India, Ukraine, or be it the Hamas war that we are seeing. The global risk scenarios, and I will touch upon a few of them, not all of them. The higher interest rates leading to global recession. Recession is something that we have been hearing or mongering about since quite some time now. The economists have placed this as one of the scenario which will have a high impact and a moderate probability. While the interest rates have stayed high for a couple of years now, especially in the US, where interest rates were increased to combat inflation, it has now lead to a monster which might lead to defaults, which might lead to defaults for borrowing, and it might also impact consumption now, which will lead to recession. So there is a moderate probability of something like this happening, of this scenario happening, and a high impact. Of course, I will encourage, in case you guys can Google the Economist report. This is very easily available, and go through all these scenarios because shows how we can insulate our organization if any of this occurs. The Israel-Hamas war is something that they have highlighted here, and it might escalate into a regional conflict. It has a very low possibility, but it has a very high impact. Again, China increasing state controls. It has a low probability, then again a high impact. Green subsidies spur global trade war. It has moderate probability but high impact. And AI undermines trust in political institution. Moderate probability but low impact. Climate change is something that they have posed as high probability and moderate impact. But I would like to highlight that this might be a moderate impact for now, but it will be a huge impact in future when we look at the global outlook. Of course, this has been evidenced by the World Economic Forum report that we have just seen. So the underlining statement over here is that in 2023, resilience among consumers and gradual fall in inflation will reassure uneasy investors and supported modest global growth. We also expect a stable but unspectacular, nothing like, double-digit growth in any economy or something happening, but spectacular global growth to continue in 2024 as economic uncertainty recedes and major central banks begin to lower policy rates in the second half of the year. So probably by the second half of the year, according to economists, we might see the global interest rates coming a little down. The Gartner has also issued regional emerging risks. So this is very useful. This is very useful from a very regional point of view. For example, for me as a risk manager, if I have to assess what might be the risk that can impact at a global level, my area, Asia probably, or South Asia, or India, or more regional, I can see the top 5 risks that the Gartner has outlined is China trade tensions, financial planning uncertainty, evolving socio-political expectation, new extreme weather events, stagflation expectations. If you would see a common thread, evolving socio-political expectation, new extreme weather events is something which will run throughout the regions. This is something which is a reality, and it is high time that we really adapt our organization to the changing environment in terms of climate change and in terms of socio-political expectations. Summarizing the entire Gartner report into small 3 concepts, the 3 risk theme that underlie the 12 risk hotspots for 2023 for Gartner are the triple squeeze, renationalization, and resilience thinking. The triple squeeze talk about the cost pressures that the organizations are facing, the supply chain disruptions that are happening, and the workforce management, the availability of workforce management. This we saw in the COVID time as well. It was very difficult to find quality IT people across the industry. There were a lot of, especially in US, a resignation drive that happened. So workforce management stay as one of the triple squeeze risk that an organization faced in 2023. Renationalization, cyber threat, of course, omnipresent everywhere. Multipolarization of ESG regulations, because ESG is a very widely developing area. Its regulations are also adapting. The regulations from BRSR itself that we can see are changing every year. So multipolarization of ESG regulations, a plethora of ESG disclosures that are requirement by the listed entities, and data governance, of course, linked to cyber threat. The data that we have, the governance around that data is extremely important, and rethinking resilience, climate degradation, macroeconomic volatility, and third party risk management, organizational resilience. These are the rethinking resilience risk that Gartner is highlighting. Moving on, I will talk about emerging risk themes globally in 2024 when the slide moves.
Yes, ma'am, the slide is visible.
So very broadly putting the 5 themes for 2024, and this is more of a theme from the previous research and the risks that are currently already existing, and we might see them continuing in the near future. Global catastrophic events, geopolitical risk tensions. We have seen a lot of events happening globally this year. This might be something, or the impact of these events might continue in the year to come. Global recession, high interest rates for too long. This can lead to global recession unless and until there is a risk unless until there is a reduction in the interest rates globally. Climate risk, of course, if we really do not do anything drastic, this is something which will pose a very big threat in the coming decade. Cybersecurity, data governance and sophisticated attacks, and third-party risk management. For evolved organizations, outsourcing their operations was one thing, but now with the increasing lucrative models, we have seen a lot of organization getting into third-party risk management without proper governance frameworks, which can really pose a lot of risk. Third-party risk management pose a lot of risk to an organization in terms of fines and penalties when it comes to data privacy, in terms of business losses, in terms of a lot of other losses that a third-party risk management can pose in case the proper governance is not there. I have moved slide. Please tell me when you can see the last slide.
Yes, ma'am, the slide is visible.
Yeah, so the key messages out of this entire presentation, especially out of the last section, is that the change is constant. We really need to understand that the disruption is new normal. It is extremely important for an organization to embrace change, to make sure they are vigilant towards the change, and to understand that the change is the new constant. Everything will keep changing, and we really need to survive in it or make use of the unknown which might be coming in. And disruption is the new normal. That is what will that is what will put your organization apart from the other organization. If you are really able to disrupt or transform your practices and give your competitions a shock by really landing there. So we are entering a new never normal era, and organizations realize this sense of fragility already. The need to focus on resilience is apparent and already accepted throughout the industry. This is where I rest my presentation. Thank you again. Over to you, Vijay.
Thank you, ma'am, for your valuable inputs on risk and risk management. The presentation sheet which you have prepared is so informative that we are getting request for this PPT. I think anyone reading these slides will get detailed knowledge of risk and risk management. So we have few questions from participants on which we will require your recommendations and inputs.
Sure.
First question is, ma'am, can you give us with a real life example where your team must have identified any risk and the actions taken by your team to mitigate those risks?
So this happens every day. This is kind of more of my bread and butter, to be honest. This is something that I need to do as my day-to-day operation. So in the current year as well, and because of SEBI LODR requirements, twice a year we need to put risk management committee. We need to analyze the risk and refresh benchmarking exercise this year itself, where I could see a couple of risks that we were highlighting that were getting outdated, and we had to really refresh those risks. Of course, as part of confidentiality, I cannot really disclose, but updating the risk register is an extremely important part of central risk management function, and being in constant touch with the business team. So this is an expert function. This has a slight amount of independence to it as well, because this needs to keep an oversight and not really get into the operations. But there were a couple of risks which the organization were already mitigating for, but that might not have been enough. And thus we had to really adapt our organizational strategy to that risk. And this is something which really happens day to day, as I am saying. And utilizing what has happened in one part of the organization, that mitigation or one risk that is highlighted by one party or part of the organization to the other part of the organization, is something that we have done day in, day out.
Okay. Thank you, ma'am. So one more question, which I would like to ask is, if since you have explained that ERM is of so much importance, then why it is not made mandatory in India? What are your views on that?
So enterprise risk management is not made mandatory in India currently. That's because it's a very evolved concept. It's a recent concept, to be honest. Not very recent, I'll say, because it exists in a lot of organizations. But normally, because this is a concept which is mandatory outside, and the MNCs operating in India have definitely adopted to it as part of their global frameworks as well. This has come into prominence. So enterprise risk management is something which is helpful, which is useful. However, it also takes into a lot of resources within the organization. And thus, the SEBI LODR requirement makes it mandatory at least for the top 500 listed entities, and organizations are finding value in it. They really need to adapt to it, and there will of course come a time when they will see the benefits of it and they will adopt it. It is still present in a lot of organization in its traditional way, where every department is doing their own risk management. It is still present in a very small way, where an organization keeps a part-time risk manager organization, but enterprise risk management does exist in some form or the other in other organizations as well.
Okay, thank you, ma'am. So, ma'am, there is one more question. Whether
Yeah.
the ESG laws are going to be enforced in India, or whether they are already, whether they have been already enforced in India.
So I would recommend going through the BRSR regulations that have been published by SEBI. These are ever evolving, these are ever changing. And while this was the first year of a lot of big organizations to report the 12 principles of BRSR, these laws are evolving, and they are evolving in a big way. The SEBI is getting more and more organizations under the ambit of BRSR reporting as we are talking. And of course, there are a lot of industry forums under which these are under discussion. And with more ESR related disclosure requirements coming our way, it is becoming important for us to understand the impact that we are having on climate, and to establish ourselves, keep it as a part of one of our organizational goal to be more sustainable and to adapt using these disclosures. They might be eye opener for a lot of organization when they understand what kind of carbon emissions some of the organizations might be putting into the system, or whether they are really compliant to it or not. This is the way of being, because a well informed investor towards an organization which is really keeping environment in its priority, that organization is definitely doing its job as part of the ecosystem overall. Only CSR cannot really help a more sustainable approach, because we all coexist in this environment, is definitely required. The mandates of BRSR, other ESG networks, other ESG frameworks is ever evolving, and there is some time till we really get onto that. But of course, if somebody wants to read through, please do go through the SEBI disclosure requirements. It's very widely available on the internet.
Okay. Thank you, ma'am. Hope your answer must have cleared the participants' questions. So, ladies and gentlemen, before we conclude this insightful session on risk management, I would like to express my gratitude to our esteemed speaker, C. Shruti Gupta ji, who have shared her knowledge with us on this crucial subject of risk management. And we have understood the importance of risk management for any organization and also in our day-to-day activities. Her informative presentation has not only expanded our horizon and understanding, but also inspired us to apply the concept of risk management while auditing and giving our clients with valuable inputs. Ma'am, we appreciate your dedication, and on behalf of all the attendees, we extend our sincere thanks for your time from your busy schedule and for impairing us with insights of risk management. We look forward for more such opportunities to learn from your wisdom in the future. Let us give a virtual round of applause to Shruti ma'am.
Thank you so much, Vijay. Thank you so much to all the committee members for really giving me an opportunity to come and share whatever knowledge that I have on the topic. And I would love to come back again and share whatever new practices that I learn and evolve in the organization. Thank you so much.
Thank you.